Usually when we talk about finance, there is this expectation of just like absolute undeniable precision. You look at a corporate balance sheet, you see a number there in black and white, and the market basically points to it, says, yep, that is the exact value of this asset.
Right, yeah. It is a very comforting illusion. I mean, we
Hmm.
really prefer our capital markets to operate like physics.
Oh my gosh.
Objective, measurable, totally binary.
Exactly. But step into the world of nature finance, and that pristine calculator just completely shatters instantly.
Oh, it really does.
Right. Like, imagine finding out that over 100 major global banks recently arranged $31 billion in loans labeled as sustainable specifically to palm oil companies.
Which is a huge number.
It is. And while that's happening, one of the primary recipients is simultaneously facing allegations of just massive primary forest deforestation. The precision totally vanishes there.
Yeah, the illusion breaks. Yeah.
Totally breaks. We find ourselves in this landscape where the financial value or, the sustainability of forests is completely dictated by whoever actually wrote the contract. So, welcome to this deep dive. Today, we are exploring a pretty brutal reality in capital markets, which is that environmental information only actually has financial consequences when an institution attaches a rule to it.
Exactly.
We aren't just looking at what a financial product is called today, we are mapping out what its underlying rules actually capture. For you, the listener, by the end of this, you're going to understand exactly how senior professionals evaluate material nature impacts and how they navigate all these complex decisions.
Because the names on the products, right? The green bonds, the nature positive funds, that's really just the surface layer.
Yeah.
If we want to understand how senior professionals evaluate these material nature impacts, we have to stop asking what is nature worth, and we have to start asking, well, who actually holds the definition?
Right.
In practice, this all comes down to what we call the rule stack.
Okay, I really want to break down that concept of the rule stack because my initial assumption, and I think, a lot of people operate on this assumption, is that if a project is green, it just gets stamped as green by some global authority and then the money flows.
Like a magic wand.
Right, exactly. So a government taxonomy, a carbon standard, an accounting framework, I just figured they're essentially doing the same thing, just maybe in different jurisdictions.
Oh, wow.
Right. I'm guessing by your face I'm drastically oversimplifying this.
You are. You
Okay.
really are. And, I mean, that oversimplification is exactly what trips up a lot of developers.
Yeah.
Because these systems are absolutely not interchangeable.
Okay.
They are entirely distinct layers of infrastructure, and each one creates a radically different financial outcome. So let's just look at the mechanics.
Let's do it.
First, you have a taxonomy. Like, think of the rumored biodiversity taxonomy that's supposedly coming from the People's Bank of China. A taxonomy merely determines eligibility. It is basically a government or regulatory dictionary that just decides if a specific activity legally qualifies for a sustainable classification.
Okay, so it gives you the official label, but having the label doesn't actually produce a product that you can, like, sell to someone else?
Precisely the opposite, actually.
Yeah.
A taxonomy just says, this activity is green. A carbon standard, on the other hand, well, that's a methodology.
Okay.
It determines if your specific intervention, like, say, protecting a specific hectare of mangrove, if that measurably generated a unit of carbon reduction that can actually be minted and traded on a registry.
Right, so that's the tradable asset part.
Exactly. Then you have an accounting framework, which tells the CFO how to organize that information on a corporate balance sheet.
Yeah.
And finally, a disclosure standard, which dictates exactly what pieces of that balance sheet external investors are actually allowed to see. So environmental impact means absolutely nothing to the capital markets until it is forced through one of these highly specific filters.
Wow, okay. So it sounds less like a single stamp of approval and more like the regulatory gauntlet that a pharmaceutical company has to run.
That's a good way to put it.
Yeah, so like the government taxonomy is the FDA saying, yes, this is legally classified as a drug. The carbon standard is the clinical trial proving it actually works in the human body. The accounting framework dictates how you write off the R&D, and the disclosure standard is like the warning label you are legally forced to put on the bottle for the consumer. Every single gatekeeper cares about a completely different set of rules.
That is the much more accurate way to look at it. And
Yeah.
for a senior practitioner, a project developer or structure at a bank, mapping this overlapping rule stack is, well, it's their entire job before they can reach financial close.
They can't just skip it.
No, they don't just build a baseline financial model. They have to actually stress test it against the specific rules of each layer.
So what does that stress test actually look like in practice? Because if I am trying to build, say, um, a sustainable forestry project, I imagine I just need to make sure I don't break the rules.
Well, it is about modeling failure stage across different regulatory authorities.
Okay.
A developer has to identify which authority governs legal permission, which lender framework dictates debt eligibility, and which methodology actually quantifies the tradable outcome.
Wow.
Yeah, and then they run scenarios. So if the carbon standard updates its methodology halfway through construction and suddenly, disqualifies your type of intervention, does the project go bankrupt,
Oh, I see.
right? Or if the government taxonomy changes, do you suddenly lose your preferential loan rate?
And if you fail one of those tests, the whole thing just falls apart.
Not necessarily, which is what's fascinating here is that failing a strict green taxonomy doesn't mean the project is dead in the water.
Really?
No, it might just be stripped of its sustainable label and then financed conventionally by another lender
Right.
under a completely different mandate at a higher cost of capital, sure.
So they still get the money.
Exactly. The underlying project is identical. Only the rule stack changed, which completely alters the financial reality.
Okay, let's unpack this. Because if the rule stack dictates reality, let's look at what happens when the rules lenders choose to use violently collide with the actual physical world. I mentioned the $31 billion palm oil controversy at the top of the deep dive. This stems from a major investigation by Global Witness.
Right. They mapped out the syndicates. Over 100 banks, including, heavyweights like Barclays, HSBC, Bank of China, and Standard Chartered.
Yeah.
They arranged $31 billion in sustainability-linked loans to Indonesian palm oil conglomerates between 2018 and 2025.
Now, to be incredibly clear and neutral about the facts of this situation for you listening, Global Witness utilized satellite inferences to link one of those major companies, Wilmar International, to roughly 4,200 hectares of primary forest loss between 2016 and 2024. But Wilmar has firmly and publicly refuted these allegations.
Yes, they have.
Right. They categorically deny that their company carried out the deforestation alleged by the satellite data. And we aren't here to adjudicate the satellite imagery versus the corporate defense. We are not taking sides. We are here to understand how a financial instrument worth billions operates under these conditions.
And the mechanism of the instrument itself, that's where the true lesson lies for portfolio managers. Because these were specifically sustainability-linked loans known as SLLs.
Okay, so how does an SLL actually function compared to like a traditional green bond? Because if I buy a green bond, my assumption is that my money is specifically going to build a solar farm or, I don't know, a wastewater treatment plant.
Yeah, that is a use of proceeds instrument. Every single dollar must be traced to a specific eligible green project. But SLLs are radically different.
How so?
In a sustainability-linked loan, the borrower can take that capital and use it for general corporate purposes.
Wait, really? Anything?
Pretty much. They can pay executive bonuses, they can buy new delivery trucks, they can keep the lights on at headquarters.
Then what makes it sustainable? I mean, if they can use the money for anything, where is the actual hook?
The hook is embedded in the interest rate. So the loan features a pricing margin that ratchets up or down based on whether the borrowing company hits predetermined performance targets.
Okay.
If they meet the target, their debt gets slightly cheaper. If they miss it, it gets more expensive.
So who sets those targets? Is there like a regulatory body that says, if you are a palm oil company, your target must be zero deforestation?
No. And that is the massive vulnerability in the system. The indicators and the targets are negotiated entirely between the borrowing company and the lending bank.
Wow.
There's no statutory benchmark.
Okay, wait. If a company is at the center of serious primary deforestation allegations, but they are still receiving an interest rate discount on a quote-unquote sustainable loan, the natural reaction from the public is that the banks are just outright lying, like the label is just fraudulent.
Well, it looks like fraud to the general public, but mechanically, it is a problem of perimeters.
Perimeters.
Yes, the rules of the loan simply measured something else. The loan contract didn't classify deforestation as a positive act. It is highly likely that the specific key performance indicators, the KPIs agreed upon by the bank and the borrower, were totally disconnected from the supply chain.
Ah, I see.
They might have chosen an indicator like, say, reducing greenhouse gas emissions at their corporate offices, or improving water efficiency at a specific processing plant.
So the company successfully installs low-flow toilets at headquarters, they hit the KPI, the bank lowers their interest rate, and calls the loan sustainable, all while just entirely ignoring the fact that the supply chain is allegedly bulldozing a rainforest.
You've just identified exactly how a bank can hold explicitly nature-aligned instruments on its balance sheet, while secretly retaining massive, unpriced exposure to ecosystem conversion.
That's wild.
The financial structure just hums along perfectly because the agreed-upon rule stack for the loan artificially narrowed the boundary of performance.
That is just terrifying from a portfolio risk perspective. I mean, if I am an asset manager looking at a bank's loan book, I can't just trust the SLL label. I have to physically open the contract and read the KPIs.
Absolutely.
So how do senior developers or structurers avoid this kind of greenwashing trap when they are actually designing these loans today?
They have to close the loopholes in the indicators. First, the chosen indicators must capture the company's absolute most material nature impacts.
Right.
So for a palm oil company, that is land use, not office electricity. Second, the targets must be ambitious against credible historical baselines, not just business as usual projections.
Okay, that makes sense.
Third, the boundary of the KPI must reach all the way down into the supply chain where the actual damage happens.
Right.
And finally, the financial penalty for missing the target has to actually hurt. If the penalty is just a microscopic fraction of a percent on the interest rate, well, it's not a deterrent, it's just a PR fee.
Right. So if the core flaw of these SLLs is that they use highly manipulable, long-term corporate indicators that completely miss the physical reality on the ground, is there a financial mechanism that does the exact opposite? Like something where the indicator triggers an immediate, unquestionable financial consequence based on physical reality?
Yes, there is.
Yeah.
And it requires shifting our focus from corporate debt to real-time disaster response.
Okay.
We are seeing this play out in the Caribbean right now with a pilot program launched by Willis, which is a WTW company, and the Caribbean Biodiversity Fund.
Right. Yeah. They just insured roughly 1,800 square kilometers of coral reef across the Dominican Republic, Jamaica, St. Lucia, and St. Vincent and the Grenadines.
That's the one.
And the mechanism pays, I believe, up to $150,000 per event to help fund immediate reef restoration after a hurricane, right? With a $1 million limit for 2026 to 2027.
Yes. But the critical part of this transaction isn't actually the dollar amount, it's the trigger. This is parametric insurance.
Which operates completely contrary to traditional indemnity insurance. Because normally, if a hurricane shreds your property, you file a claim, an insurance adjuster physically travels to the site, surveys the damage, argues with you for like 3 months about what was pre-existing wear and tear, and eventually cuts a check.
Exactly. That post-event damage survey is highly accurate, but it's incredibly slow.
Yeah, way too slow.
A parametric trigger entirely bypasses the adjuster. It pays out based solely on predefined, physically measured parameters of the event itself.
I always think of parametric insurance like a sprinkler system attached to a smoke detector. So if a traditional insurance adjuster is a guy poking around the ashes of your house with a clipboard, the parametric trigger is a smoke detector.
That's a great analogy.
Right. The machine senses a very specific physical threshold. In this case, maybe a specific wind speed or barometric pressure recorded over the geographic coordinates of the reef. The moment the sensor crosses that threshold, the sprinklers go off, and the money is wired to the local community instantly. You get the cash to start fixing the reef before anyone even dives into the water to see if the coral is actually broken.
Exactly. It converts a measured physical parameter into an automatic contractual payout. But, and this is crucial, that speed introduces a massive concept in finance called basis risk.
Because the machine doesn't actually know if the reef is damaged, it only knows how fast the wind was blowing.
Exactly. Basis risk is the discrepancy between the financial payout and the actual physical loss it is meant to cover.
Yeah.
So this specific index design creates inherent basis risk.
How so?
Well, imagine a highly compact but incredibly violent storm rips through, and it completely destroys a section of the coral reef. However, the wind speed recorded at the specific contractual coordinates was only 100 miles per hour. If the contract's trigger was hard-coded at 105 miles per hour,
Oh, no.
the policy pays zero. The reef is gone, and the community gets absolutely nothing.
Or the flip side, right. A massive, wide storm hits 105 miles per hour, triggers the payout automatically, but due to tidal conditions or maybe the angle of the waves, the reef miraculously survives completely undamaged. The community gets the cash anyway.
Exactly. In parametric design, this basis risk isn't a flaw. It is accepted by design. Structures are actively trading the perfect accuracy of a post-event survey for the vital speed of immediate liquidity.
Wow.
You have to decide which rule governs the payout, the slow truth of the damage or the fast truth of the wind speed.
Here's where it gets really interesting, though. We've looked at how these instruments, loans and insurance, function in isolation, but how do practitioners actually get these projects off the ground when they have to interface with governments? We have two contrasting examples from the news this week of how the playing field is being built right now.
Yeah, we have a textbook top-down policy approach in Canada versus a bottom-up practical development approach in Malaysia.
Right. So in Canada, the federal government recently launched an advisory expert task force on natural capital accounting and nature financing. They appointed 15 experts to figure out how to value natural assets in public and private decision-making. Now, I saw headlines throwing around a figure of 3.8 billion Canadian dollars alongside this task force. Does that mean this committee is actively deploying billions of dollars into nature projects right now?
No, and it is vital for practitioners to read past those headlines. The $3.8 billion belongs to a broader national strategy that was actually finalized back in March.
Okay, got it.
This specific task force is purely advisory. The Canadian initiative is entirely about establishing the top layer of the rule stack, the accounting framework.
Just the theory.
Right. They are deciding how a tree should be valued on a sovereign balance sheet. It is purely architectural.
Meanwhile, over in Malaysia, we see the gritty reality of project execution. The Sarawak state government submitted a carbon stock assessment for the Rajang Mangrove National Park, which covers over 9,000 hectares, and they are seeking regulatory approval to enter the voluntary carbon market.
Which perfectly illustrates the immense friction of the rule stack we discussed earlier.
Yeah.
Submitting a carbon stock estimate might secure state regulatory permission to operate.
Yeah.
But state permission does not equal a financial asset.
Why not, though? Because if the government says, yes, you have our blessing to sell carbon credits from this mangrove, shouldn't that be enough for the market?
Because buyers in the voluntary market don't just care about legality. They care about impact.
Right.
To turn that mangrove into a tradable unit of carbon, the developer has to navigate an applicable global carbon methodology, which is separate from the state. And the absolute hardest part of that methodology is proving baseline additionality.
Additionality, meaning essentially proving that the carbon wouldn't have been saved if the project didn't exist.
Right. You have to prove a credible counterfactual threat. You have to mathematically demonstrate that without the revenue from selling these carbon credits, this mangrove forest would have been destroyed by logging or agriculture.
But wait. It's the Rajang Mangrove National Park.
Exactly.
If it's already a designated national park, hasn't the government already legally eliminated the threat of it being chopped down?
And there's the paradox that haunts developers. If the state strongly protects an area, the legal threat is gone, which ironically destroys your ability to claim additionality in the carbon markets.
Oh, wow.
Yeah, you can't claim you saved a forest that was already legally shielded.
Yeah.
So the developer in Sarawak isn't just fighting for government approval. They are fighting a complex methodological battle to prove that despite its status, the mangrove is still under systemic threat that only carbon finance can solve.
The gap between those two worlds is just staggering. You have 15 experts sitting in a pristine conference room in Ottawa debating the theoretical accounting value of a tree, and a developer in Sarawak agonizing over how to mathematically prove a mangrove is in danger just so they can generate a single tradable credit.
It is the ultimate difference between policy intent and market execution, and it leads to a massive structural problem.
Which is?
With all these overlapping local regulations, parametric triggers, and strict carbon methodologies, how does any of this get reported to the global capital markets in a way that is actually standardized?
That brings us to the integrity architecture. We're about to see a wave of biodiversity disclosures hitting the market. The International Sustainability Standards Board, the ISSB, is targeting October 2026 for an exposure draft on nature-related requirements.
Now, a critical detail for the practitioners who are modeling out their compliance costs over the next few years. This upcoming ISSB release will be an IFRS practice statement. It will complement the existing S1 and S2 standards. It's not going to be a brand new standalone mandatory standard.
Just briefly, for context for you listening, S1 and S2 were the major standards that essentially forced corporations to finally quantify their baseline climate risks and greenhouse gas emissions in a standardized way for investors. So this new practice statement will essentially try to bolt nature and biodiversity onto that existing climate reporting machinery.
Exactly. And simultaneously, the Task Force on Nature-Related Financial Disclosures, the TNFD, is wrapping up a major status report survey to inform their global stocktake closing mid-August.
So if I am managing a portfolio right now, I am looking at this incoming mountain of practice statements, exposure drafts, and surveys, and I just have to ask, is this just a massive new compliance headache, or does this actually change how a senior professional allocates capital?
If we connect this to the bigger picture, it will fundamentally move capital. Because in global finance, classification distributes attention, and attention distributes money. If a standardized disclosure framework dictates that a specific supply chain practice is a material nature risk, well, capital will flee that risk. If it classifies a certain asset class as nature positive, capital will flood toward it.
Which means whoever rates the reporting framework dictates the flow of the global economy.
Which is exactly why the Pacific Small Island Developing States issued a stark unified warning this week. They pointed out that the current global reporting frameworks severely, systematically undercount customary and community conservation.
How does the framework miss that? If a community is protecting a forest, shouldn't the data just show it?
Well, the frameworks rely heavily on what is easily legible to Western financial institutions. They look for formal legal designations like national parks, or they rely on broad satellite data that might not capture nuanced ground-level stewardship. Indigenous communities have been managing and protecting ecosystems for centuries through customary practices that just don't neatly fit into a corporate spreadsheet or a standardized taxonomy.
So, if the rule stack only recognizes formal government decrees or specific technological metrics, centuries of effective indigenous stewardship remain completely invisible to the balance sheet.
And if the disclosure rule doesn't see it, the financial market simply won't price it. Therefore, integrating indigenous knowledge in community conservation cannot just be a philanthropic afterthought.
Right.
It must be built directly into the core mechanics of this integrity architecture. Otherwise, we are building a global financial system that structurally ignores some of the most effective nature conservation on the planet simply because it doesn't fit the formatting of the accounting framework.
So what does this all mean for you? Whether you are prepping for a boardroom strategy session, stress testing a new financial model, or evaluating a broad asset portfolio, the ultimate lesson is super clear. You cannot take the marketing at face value. Labels like sustainable, nature-aligned, or green, they are not substitutes for doing the grueling mechanical work.
Definitely not.
You have to map the rule stack. You have to open the contract and identify the specific indicators being manipulated. You have to see what the rules actually capture, not just what they claim to represent.
Because as this financial architecture grows exponentially more complex, with competing taxonomies, basis risk and parametric triggers, new practice statements, and heavily negotiated sustainability-linked loans, it leaves us with a critical, unresolved question.
That's that.
Will the global economy actually evolve to value the messy, intertwined complexity of the natural world? Or will we simply end up valuing whatever happens to be the easiest thing to measure on a spreadsheet?
That is the thought to take with you today. The next time you look at a perfectly precise, clean number on a balance sheet representing a forest, a mangrove, or a coral reef, ask yourself, what exactly did the rule stack leave out? Thank you for joining us on this deep dive. Keep looking past the labels, keep examining the underlying rules, and we will catch you next time.